Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. In the last week or so, the markets have been volatile, so should you be concerned? Also, third quarter earnings reports are now coming in. We'll talk about that. And gold has been hot, so should you jump in? It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial experts and advisors, and they are Carrie Coghill of Coghill Investment Strategies. Also sitting with us is Frank Rossetti. Frank has his own alternative investment company, HF Management Company. Also at the table is Kim Forrest of Boca Capital Partners, and also Michael Godwin, the Chief Investment Officer for Fragasso Financial Advisors. Thanks again for joining me for The Bull, the Bear, and You. Now, the last time I said this seems like a long time ago. Since the last time we met 2 weeks ago, the major stock indices all registered declines for that 2-week period. But before they took that step back, a small step at that, the NASDAQ, the S&P 500, and the Russell 2000 all set new all-time closing highs. So make no mistake about it, all of the indices are still showing significant gains for the year. But the last week or so has seen an increase in volatility. In fact, measurement of volatility, the VIX hit an intraday high not seen since April. So my question to begin our discussion is, what is the VIX, and should we be paying attention to it as regular investors?
Michael, you can take that.
Thanks, Frank. Yes. The VIX it's a measure of volatility in the stock market. I mean, again, try to simplify it. It's often called a fear gauge. So when the stocks drop precipitously or by any degree really, the VIX generally goes up. It's directional. It's essentially directional based on the movements in the S&P 500. Should investors be paying attention to it? My opinion, and I traded volatility or options, in earlier in my career. Any long-term investor, I don't think really should pay much attention to the VIX. Short-term investors, you can due to hedging practices and whatnot, but the one thing it can do, it can maybe, Stacy, be a contrarian indicator. So if the VIX pops up above, call it 30, 35, that could be essentially a buying opportunity in the stock market. It's almost like a buying the dip mentality over the long haul. Now, the VIX jumped up to, I don't remember what you said, 1920 or so last week. That's really not that high. Back in April of 2020, back in when the COVID pandemic started, the VIX was over 80. It was like 85 or something. So we're still pretty low in regards to sort of the fear gauge or the VIX. But in my opinion, any long-term investors really should not be paying too much attention to the VIX.
Well, should they be paying attention, though, to the volatility that is happening at all?
I mean, they're one and the same. I mean, again, anytime you have any sort of economic move, any economic news, whether it's the cockroaches that are coming out that Jamie Dimon says in private credit, or anything regarding trade narratives, you're going to get a little volatility in the index. I mean, you cannot make money sitting on the sidelines in cash, right? This is a risk asset. It's not a risk-free asset. You're going to have volatility in any given time based on what's going on in the economy. So would I be paying attention to the VIX? Not so much. Would I be paying attention to the other economic indicators that are probably happening out there? Yeah, the VIX is a coincident indicator with the S&P 500. As the S&P 500 drops, guess what? Your VIX goes up. So it's not really going to tell you anything predictive going forward. It just tells you what's happening right now.
And I'm going to concur because I am the typical long-term investor. I don't really care about volatility. In my first job in this field, my director of research, Larry Horan at Parker Hunter, was arguing with the investment committee that risk and a stock's volatility are two different things. And I agree, because if you're in the market, theoretically, this isn't your pocketbook, this isn't your checking account, this is long-term assets. So whenever we get in rock and roll territory where prices are rising and falling very quickly and VIX is very high, What you should be asking yourself is why is it, and is it going to last for a long time? Most of this, I think, is news driven, and you can use the VIX to start searching the newspaper for why it's happening.
I would agree with that, when we do see the VIX go up, it's worth looking at. So my approach to this may be a little bit different. We follow the VIX pretty closely because it does give us some indication of kind of what type of, excuse me, what type of sequence we might be seeing in the market, right? So we have had periods of time where the market just kind of steadily goes up or steadily goes down. When we see the VIX go up, that does sound off kind of a signal to us that we should be looking for why. And to Michael and Kim's point, long-term investors really don't need to pay attention to this. But that statement is kind of unrealistic because we're all paying attention. And all of our clients are long-term investors, but you know what? If we get a decline of 10%, all of a sudden they're short-term investors. So it's our job to make sure that we stay ahead of these things. And, just in the research that we've been doing since we've started to see the VIX climb, and to Michael's point, it's not anywhere close to where it was during COVID. But if you want to get ahead of things, you kind of have to look at things on the margin, right? Because to get to 80, you have to get to 19 first. So when we're looking at this, it does start to cause us to raise some awareness about where we may be putting money to work today. Because volatility isn't just downside volatility, it's upside volatility too. So you start to get these swings. And if you go back to 2008, we had days where the market was up 1,000 points, down 1,000 points. So it's never in a straight line. And the VIX kind of helps us to understand the bumpiness of the market. As we've started to dig into this, I do think that private credit is a challenge. I do have concerns about, we're just starting to get some rumblings for different reasons with the regional banks and, what about commercial real estate? Like there are things that we can start to look at, not that it's going to cause us to make a change with a client, but it may cause us to want to rebalance their portfolios back to target or to dollar cost average if they have money going into the market. So I personally really like using the VIX to kind of help us along with trying to predict the unpredictable.
So maybe what you're saying goes hand in hand with a headline in the Wall Street Journal this morning, which is the warning signs lurking below the surface of a record market. Utilities, healthcare, and consumer staples are leading the S&P 500 this month. Is that kind of go hand in hand or not?
What that's telling you, Stacey, is investors are becoming more defensive. Those are defensive plays. They're concerned that the market might sell off here. It's an interesting thing. It's probably one of the reasons the VIX has begun to climb. But going back to the VIX thing, I always used it as an entry point signaler. When somebody sells a business, gets an inheritance, comes up with a large amount of cash, one reason or other, gets a bonus, whatever it is, and they've determined they want to invest it in the market, I use the VIX, always use the VIX a lot as an indicator of whether I want a dollar cost average. If it was down around 12 or something, I'd probably rather dollar cost average. If it's up around 35, which it's not, I would probably be more likely to go all in, as Mike indicated before. So it's something to pay attention to. It's, as Carrie said, it's a reason to rebalance things. All right, it needs to be paid attention to because it's telling you something. And you have to figure out what that means for your long-term objectives. And as far as the early sign that people are getting defensive, it's a little early to call this a signal, but it's certainly something to pay attention to.
Okay, good advice there. Now, the Trump administration's varying stance on China and tariffs seems to have fueled a lot of this volatility. So how do earnings and increased volatility play out, or is there any connection between the two of those?
it's driving it. I mean, that's the news right now that's driving, at least you can watch it as news releases are happening, that people get really, really nervous, and for a good reason. You know, even though we have been trying to, probably over the last 9 years, kind of de-link a little bit from China for many reasons, we have been unable to really break that bond. And it is scary for both consumers and many businesses about what China, if they decide not to sell us, oh, I don't know, rare earth minerals, if that happens, you know, it could impact consumers around the world. So there are real reasons why VIX goes up, and, you know, people get nervous. Now, when the opposite happens too, some nice words come out on the news wire saying, oh, China and the US are still talking, you know, down it goes. So, yeah, I think that's an excellent example of what could be driving the market.
I guess what I was really asking, Kim, is there a connection, though, between the volatility that we see and also the earnings reports, which is we're in the earnings report season right now?
Not yet. Not yet. We are in, God knows I love it, one of my 4 favorite times of year, earnings season, but we've just gotten through the banks. And the banks are the biggest coincident indicator. They tell you what happened in the last quarter and what's happening right now. But because companies and individuals don't have to plan, there's not a long runway whenever you say, hey, I want to borrow money from a bank, or I want to do a deal, you know, and the deal gets done. So we can't really use them for very much future looking data. But things have gone really well in the last quarter, much better than people have anticipated. Now, Carrie has given a nod to this. There are some cracks showing in the financial industry, not necessarily having to do with banks, or maybe touching the most aggressive, small, risky banks, and that is with private credit. Because oddly enough, private credit have borrowed from banks to go out and do credit. It's this, you know, snake eating its tail thing, which is never a good sign for investors. But I'm actually really glad, because I've been worried probably, again, since 2016, whenever the private credit really came up as something for high net worth individuals to kind of look at and participate in. I'm glad seeing cracks, because this isn't like woe begone. I love this. Not everybody is above average, and there are going to be private lenders that don't have to follow the same rules banks do, can give out higher, riskier loans with higher interest rates, and they're not good at their job. They're not good at underwriting risk. So these cracks make me feel good that, you know, life works as I think it should, which is higher risk really needs to have higher interest rates, and you have to be a better lender to play in that market.
Just to add on to that, in my alternative fund, I own a private lending vehicle, and they have been open for about 3 years now for business, and they have managed to invest, fortunately, I think for me, very carefully, and we still have 80% of our money sitting in a short-term interest-bearing account waiting for it to be called, because they are being very careful as they go. And they've been doing this for 3 years, and they have until another year or so before they have to get this money invested. And my job is to make sure they don't get careless because they're going to run out of time. And if I sense that, I'm going to ask for my money back. All right, and hopefully I'll get it, because they also have rules about how they pay you back. But that's the risk in these things, and this is why we've talked about this in 401ks, and I'm not in favor of it by and large, because most people are not equipped to take the kind of risk I'm taking in my fund, whereas my clients that are in it are, and I keep them sometimes painfully aware of what's going on, because I believe in transparency. And so they know what to worry about, what not to worry about. And fortunately, because they're sophisticated investors, they are not concerned, because we're watching it.
Carrie, you mentioned a moment ago about, and so did Kim touch on it too, about these some issues with a couple of regional banks. I can remember just what, a year, 2 years ago when the banks in California had issues, and it seemed
Yes.
to have a major impact on the financial stocks at that point. Is this going to grow like that as well?
I think that the issues at hand right now were really related to some wrongdoing, right? Some fraud, which, I would say something like that is probably isolated, but it just starts to kind of put the spotlight back there, and really kind of got, you think about why those things happen. And in my mind, it all comes back to that whole lending situation and private credit. And, if there was a wrongdoing, were they trying to cover something up? Like, what were the specifics of that? So then you just have to continue to kind of peel the layers of the onion back. And we want to watch that. We want to watch that pretty closely, because the growth of the private credit market has been significant over the last several years. So, does that, again, like, one of the reasons why people hire us is, number one, to help them discern the real risks from the perceived risks. So, for example, your question about, is the situation with China impacting earnings and impacting the markets? Yes, the headline is, but do we look at that as a real risk, or is that just negotiation? I tend, let's not forget, Trump wrote the book, The Art of Negotiation. So I tend to lean towards, I'm not too worried about that at this point, versus looking at, okay, we have a couple incidences here with the regional banks. Do we want to start to peel back that onion? So that's really why people hire us. And the other reason why is to know, do I need to react to this? Or is this just part of being an investor? And usually, if you're allocated properly, own high quality, that matches your risk tolerance, usually our job is to make sure people stay focused on that for the long term. So, we're not thinking there are major issues going on, but I mean, honestly, these are the times that we tend to feel really good about our job, because we can add some value and add some insight so that clients can sleep at night.
You're shaking your head, yes, Michael. I assume you don't disagree.
I disagree with most of what Carrie says normally. No, I'm kidding. Carrie, she says the China thing. I've said it a million times. I don't invest based on geopolitics. I have no idea what's going to happen between Trump and President Xi and all that kind of stuff. So I try to stay away from that fray in regards to making investment decisions there. We've been long, meaning we've owned some private credit for 5 years probably now. We've been reducing it a little bit. We still like it longer term. It's interesting. I think all of the problems with the regional banks are very idiosyncratic and somewhat isolated. It's been a couple of companies that have sort of defaulted on the debt in the auto sector. The big problem, though, is, and I think maybe what Carrie is sort of alluding to a little bit, is our economy is all based on trust in the system. I mean, that's really it. When you look back at like the financial crisis of '08, when the biggest banks in the world, like Morgan Stanley was about to go under, Goldman Sachs was about to go under, all these big banks are about to go under because people lost trust and they pulled all of their money out of the system. Once that happens, there's generally no going back. So even if you take a look at private credit or any high yield fund, for example, if you get a lot of distrust in the system and people begin requesting the money and pulling money out, that's just a domino effect that can really ripple its way through not only that asset class, that sector, but throughout the economy as well. I don't think we're anywhere near that at all. But the more and more headlines that kind of come out, even if everything is kind of fine, it does give you a little bit of caution.
You're talking about the headlines. I happen to agree with Frank on this one. I think the media overplays it, given what all of you have said about the regional banks. You see the headline and you listen to some of the financial networks, I guess I'll call them, regional banks are in trouble. Da, da, da. I mean, that seems to be the headline that comes out, and it's not true, right?
Right.
Yeah. Okay.
They're so again. The last point. These banks are so much better capitalized right now. Their net interest margins are very very strong and positive. So they're making money off their loans. Their tier one capital ratios, which is how much money they have, set aside. It's all really pretty good. These are, in my opinion, so far, just idiosyncratic events.
All right, now we're very early in the third quarter earnings season, if I'm not mistaken, and so mainly the financials have come in so far because they're always the first to report. What are your anticipations for the rest of the sectors at this point?
Well, I'll launch in here. I think it's going to be a pretty good quarter, I have to say, and more importantly, things are pointing to, at least in the companies that are kind of off camber, that have just reported in the last couple of weeks, and their reporting isn't on a normal quarterly clock. It's a little bit off. I think companies set low bars for their earnings. I do think they're raising them, and I don't know why, but it does seem like the consumer continues to hold up. And I have to put this plug in too. We have been absent of any meaningful data from the government, which we as an industry depend on incredibly, right? And yet we've been able to suss out that unemployment's kind of holding in there, through some third-party checks from banks that will go out and, investment banks and that kind of thing will go out and try to find out from third-party sources like ADP, that sort of thing. We can suss out that, the end of the world economy is not nigh. And we're getting from companies that they, too, are seeing demand is relatively good. There are going to be pockets of badness. I'm looking at Cleveland Cliffs as not, I guess they report later today. That's not going to be a tremendous company, but that's, it's a company that isn't well. We'll just put it that way. So, don't read too much into that. But by and large, I think we're going to have a pretty good earnings report, and that we are not going to adjust lower guidance going forward. They're going to maintain guidance in light that we don't have all of the economic data that everybody depends on in making a lot of those forecasts.
One thing that, since you brought it up, Kim, Cleveland Cliffs this morning, I think, threw out a concept that they're working on about getting rare earth metals out of the steel somehow, and it caused the stock to pop. So it's amazing. I mean, this is just a concept. They have no evidence that they can do this yet, but the market reacted to it. And that stock has been a trading vehicle for gamblers for years, and it continues to be that.
Well, now that we're on rare earths, I just have to toss this out. And this is the kind of life I lead. I had to go somewhere yesterday with my husband in the car for like an hour and a half one-way trip, right? Or, it's like 3 hours altogether. So we're just kind of cruising along on the highway, and I'm like, I think somebody's going to come up with a better way to process rare earths, because they're not that rare. And that's what America does. So these are the kind of conversations we have in the car. God help that man. Uh-oh. Sorry.
It's all right. We didn't know what was happening there. So
Yeah, well, I said a word that opens up my phone, and it started talking to me. So I'm not going to say that again.
Don't you love it when that happens?
Oh, God. Our modern life.
Since you brought up rare earth minerals or whatever, I guess there's one commodity, and that would be gold. We talked about it a couple of weeks ago, and that is, since the beginning of the year now, I believe that the price of gold has doubled. So are gold-related stocks something that people should be looking into, or do you guys think it might be just too late to invest in gold right now?
So I will lead this off. We really don't I mean, I've been doing this for a really long time. Next year's 40 years. And this conversation happens like, I don't know, every 5-7 years. We see gold spike and then it comes back down. It has not been, for people that are long-term investors, it has not been in and of itself an asset class that we feel has added value to a portfolio. So to your point, like, yes, gold related stocks have also gone up, and they've gone up significantly. But if you're, as I said, if you have kind of a diversified portfolio and you look at having an allocation into gold and looking at that over the long term, it's not really been additive to a portfolio. It is definitely more of a, people have FOMO right now, it's going up, I need to get in. There are reasons why we've seen this increase. We have a weaker dollar. People are concerned about geopolitical events. They had been concerned about inflation. So kind of when you check off the boxes as to why someone may, in the short term, own gold, we've had a lot of those boxes checked for the year, but that doesn't make it a good long-term investment.
When I look at a long-term investment, I always preach that there's three things an investment can do. It can appreciate, it can provide income, and it can be liquid, which means it can be easily sold. It's the only three things any investment can do. I've never seen an investment that can do all three. Gold only does one, which means it's not an acceptable investment in my mind, because I want my investments to do at least two of those things. In the alternative space, I have income and appreciation potential, but no liquidity. All right, that's a risk most people can't afford. Okay, in bonds you have income and liquidity. In stocks you have growth and liquidity. In stocks that pay dividends, they just came up with a study, they almost always underperform the growth sector of the market. So, you have to sit there and look at it in very simplistic terms, which is what I just did. And gold only provides the potential to rise, and things do not grow to the sky, last I checked.
Historically speaking, after gold has a run like it has had, right, over the past couple of years, your future years' returns, whether it's 12 months, 18 months, even like 36 months, are generally relatively muted. Now, again, context is key here. I mean, each period is very different from the one we're in. Can gold continue to rally? Yeah, maybe. I mean, Kerry pointed out a lot of issues there, whether it's geopolitical news, people wanting to de-risk out of the dollar. Other countries have been so long the dollar for a long, long time because it was the best game in town. They were making a decent amount of money there. They were hedging it back. They were not hedging it back to their currencies. They're doing it now, so you got to put money in gold there. But I would be leery of making any new investments into gold simply because it's done very well over the past year or so. It's kind of like the Bitcoin example, right? People see Bitcoin going up, 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 up. I got to get into it because it's just going up, whether it's and not looking at it as, is this a good investment for the longer term, or even a relatively mid-range term. So I'd be kind of leery of investing in gold after quite the run-up we've had so far.
And let me put the capstone on this. I agree, because it's a commodity. I generally dislike owning commodities because they are priced because of supply and demand. And if I'm going to own a gold company, and even some kind of energy company that's specifically focused on getting this stuff out of the ground, not necessarily doing anything, with it after that, I really don't like to own those things because the value has been falling over the decades. It is so much cheaper to get stuff out of the ground now. So what the company is being paid for is its the ability to get the stuff out of the ground. And it has the trade of, yes, it owns the stuff in the ground, right? If you're a gold mine or if you're an oil company, you get paid on a multiple of that as it goes up and down. So this is something that really trades based on supply and demand. You can't really forecast it. So I just try to stay out of it as much as I can. I have to own energy. I generally own energy companies that not only get it out of the ground, but then refine it, sell it, do more, have more of a value add to that chemical or that, item rather than just extracting it.
All right. Good. Well, we'll continue to look at our investing in the economy in future editions. And since you're watching or listening to this program, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. But for right now, thanks for joining us. We'll see you again in about 2 weeks or so for the next edition of The Bull, the Bear, and You.